Hi, I'm Abhishek Mehrotra, Head of Investment Products with HDFC Securities Limited. This video is about 5 current threats on Indian equity market and how to deal with them. So here are they. 1. Rising inflation rates. Rising inflation rates result into lower disposable income in hands of investors and increases the input cost to companies, impacting profitability. Second, geopolitical tensions. We all are aware about Russia-Ukraine war. Europe is under pressure of moving into recession. China is yet to move out from COVID restrictions. All this is increasing the risk in the market. 3. Higher crude. India being net importer of crude, every $10 increase of crude rises inflation by 10 bips. It also rises cost of goods as crude is either used as a raw material like in paints and airline industry, or it's part of overall transportation expense, finally reducing profitability. Fourth, rising interest rates. Rising interest rates makes capital costly, increases payments for companies having debt on their balance sheet. This also raises EMI payments on purchase of durable and housing property. Fifth, dollar index and US markets. Rising dollar makes Indian assets less attractive, resulting into FII moving towards dollar denominated assets. US economy is going through tighter monetary policy, creating a risk-off scenario for investors. All these threats have come together, resulting into higher volatility in equity market. And the best way to deal with them is via systematic investment plan, as equities in long term gives greater inflation-adjusted returns. Systematic investment plan is simply investing a fixed amount on a specified date over defined time period, say 20,000 per month for 5 years on 1st of each month, which you can do by clicking a few buttons on HDFC Securities website or mobile app. Investing a particular amount in mutual fund every month through the ups and downs of the market movement gives benefit of rupee cost averaging, by which you as an investor benefits by buying more units when the market is down and less units when the market is up. When you invest in SIP, it's a long-term commitment starting with only a fraction of investment amount. If you plan to do an SIP for 10 years or 5 years, you will be investing 1 to 2% of your total investment amount in a month. Finally, there is no need to look at present market levels. Just initiate your investment and reap the benefit of steady appreciation over long term, taking advantage of compounding and rupee cost averaging. Refer to our website or mobile app for SIP options or speak with your HDFC Securities relationship manager. Thank you.